Welcome to the Deep Dive. We're here to give you the quick download on important developments.
Think of us as your shortcut to getting up to speed.
Today, we're jumping into the first quarter 2025 earnings call for Viking. We've gone through it, pulled out the key results, the strategy talk, and what they're saying about the future.
Yeah, our mission really is to unpack it quickly. What were the numbers? What's the story behind those numbers? And what does it all suggest about where Viking's headed?
More than just the data dump, right? It's the context. What drove things, how healthy is the business, and how confident does management sound?
Exactly. Let's get into it.
Okay, so first quarter 2025, the big picture. They definitely carried momentum forward. Total revenue was nearly $900 million.
Which puts things in perspective. That's up almost 25%, 24.9% to be exact, compared to Q1 last year. A big jump.
And a key part of that was net yields, basically. Revenue per passenger per day after some costs. Those were up 7.1% over Q1 2024.
And this wasn't, instead of growth, it was alongside growth. Capacity was also up significantly, 14.9% year over year.
So more capacity and getting more revenue out of each available day. That's the goal, isn't it?
Pretty much. Their adjusted gross margin reflected this, up 23.8% to $613 million.
But here's a number that really caught my eye. Adjusted EBITDA. It was positive $73 million.
Yeah, that's actually pretty notable. Q1 is typically their weakest quarter, seasonally speaking. Often they see negative EBITDA.
Right.
So getting a positive $73 million is a huge improvement year over year. It shows that revenue growth is really flowing through good operating leverage.
Now, even with positive EBITDA, there was still a net loss. Adjusted net loss attributable to the holding company was $15 million. Which
was still an improvement from Q1 last year. Adjusted EPS came in at a loss of $0.24.
But they did frame it as building on last year's momentum. And interestingly, they mentioned Q1 revenue now is almost 3 times what it was back in Q1 2019.
Shows you the recovery and, frankly, the growth beyond pre-pandemic levels. It's quite a trajectory.
So how did they pull off that revenue increase? It wasn't just adding ships, right?
No, it was a mix. Increased capacity, yes, but also higher occupancy rates across the ships. And like you said, that higher revenue per available day.
And costs. Any good news there?
Actually, yeah. Vessel expenses, excluding fuel, measured per capacity day, they actually decreased 2.3% year over year.
Huh.
How? Well, partly because the increased capacity helps spread those fixed costs over more guests. Better leverage, basically.
Makes sense. Okay, let's break it down a bit. River versus ocean. How did they compare?
Okay, river segment. Capacity saw a big jump, up 22.3%. That was mainly new ships for Egypt, plus more European sailings.
Occupancy.
Strong. 93.9%, which was up 1.8 percentage points from last year. Adjusted gross margin for river grew nicely too, 21.5%.
But the net yield for river was down slightly. 2.7%.
It was down to $593. But, and this is a big but, they were very clear on the call.
The seasonality warning.
Exactly. Q1 is not the main season for river. That really kicks off April through October. So you can't read too much into that Q1 yield dip for the river segment. It's likely just timing.
All right, good context. So What about ocean?
Ocean capacity was up 10.4%, mostly from adding the Viking Vela. Occupancy was also really high, 94.4%, pretty much flat with last year.
And the financials.
Strong growth there. Adjusted gross margin up 25.3% to $395 million. And ocean net yield saw a really significant increase, up 13.6% to $499.
Okay, why the big jump in ocean yield compared to river's slight dip, even setting aside seasonality?
2 main things they pointed to. First, the mix of where ships were sailing more European itineraries, which generally command higher prices.
Okay.
And second, they only had 1 world cruise operating in Q1 this year versus 2 last year. World cruises are great, but they tend to have lower net yields per day.
So fewer of those lower yield days pulled the average up.
Precisely. And they even added that if you strip out the world cruise effect, the underlying ocean net yield for Q1 was still up by high single digits compared to last year.
So real underlying strength there too. Okay, let's shift to the balance sheet. How's the financial health looking?
Looks quite solid. As of March 31st, they had $2.8 billion in cash and equivalents, plus access to another $375 million through an undrawn credit facility.
And debt?
Net debt stood at $2.9 billion. But with the strong cash position and good EBITDA performance, their net leverage ratio improved. It went from 2.4 times at year-end 2024 down to 2.0 times by the end of Q1.
2 times net leverage is pretty healthy. What about customer deposits?
Huge number there. Deferred revenue was $4.8 billion as of March 31st. That's cash they already collected for future cruises that are booked.
Well, $4.8 billion, that gives them incredible visibility, doesn't it? And cash flow stability.
Absolutely. And on the debt maturity front, they mentioned one bond that was due in May 2025 has already been paid off. All the other significant maturities are pushed out to 2027 or later. So no major near-term pressure there.
What about scheduled payments?
For the rest of 2025, it's about $439 million in principal payments. And for all of 2026, it drops to $217 million. Seems quite manageable.
Okay, so a strong financial base. Let's look forward then. Strategy, outlook, expansion. What are they planning? Ship spending must be significant.
Oh, yeah. Committed capital expenditures for ships. For this year, 2025, it's about $850 million gross, or $440 million net of the financing they expect.
And next year?
That jumps up quite a bit. For 2026, they're projecting about $1.1 billion gross, but only $140 million net of financing.
Why the big jump in gross spend for 2026?
That's mainly driven by 2 new ocean ships scheduled for delivery, then the Viking Mira and the Viking Libra.
Got it. New ships feeding growth. This brings us to the booking situation, which sounds, well, pretty amazing.
It really does. As of mid-May, for their core products combined, 2025 was already 92% booked.
92%?
Yep. Translates to $5.5 billion in advance bookings. And get this, that's up 21% compared to where 2024 was at the same time last year.
Even with more capacity.
Even with 12% more capacity this year. They basically said 2025 is practically sold out from a cabin occupancy perspective.
Incredible.
Yeah.
So if you haven't booked for 2025, maybe look at 2026. How's that shaping up?
Their focus is definitely shifting there. For 2026, they're already 37% booked.
37% booked already for 26.
Wow. Represents $2.7 billion in advance bookings. And that's 11% higher than 2025 was at the same point last year, even factoring in another 8% capacity increase planned for 2026.
Where's that 26 capacity growth coming from?
It's the full year effect of the ships delivered this year, plus those 2 new ocean ships and 6 new river vessels coming online in 2026.
6 new river boats, too. Okay, let's break down the bookings. Ocean first.
Ocean 2025, 91% sold, $2.4 billion booked. That's up 27% year over year on 18% more capacity.
And Ocean 2026.
Already 45% sold.
Yeah.
The average rate they're getting for those 26 bookings is $784 a day, which is higher than the $747 they had for 25 at this point last year.
Higher rates and higher bookings.
Yep. Advanced bookings value is up 15% year over year for Ocean 26 on a planned 9% capacity increase.
Okay, how about River?
River 2025 is even more booked, 95% sold. Almost $2.7 billion in bookings, up 17% year over year on 7% more capacity.
And the rates.
Also strong. Average rate for 25 River is $825 a day compared to $773 for 24 at the same point.
And River 2026.
That's 28% sold currently. $1 billion in bookings, up 5% versus where 25 was last year on an 8% capacity increase. And the rates booked so far are very high, $986 a day versus $952 for 25 at this point.
So across the board, the booking momentum sounds phenomenal.
Absolutely. They called January their best booking month ever. The whole wave season was their best ever. More guests, higher prices.
And it didn't just stop after wave.
Nope. They said momentum continued right through April and May, with bookings up year over year. They even mentioned particular strength in just the last few weeks of May.
Did they touch on the broader economy? Any worries?
They mentioned it briefly, said their operations are mainly in Europe, ships built in Europe. They feel somewhat insulated from, say, global trade tensions, minimal direct impact expected.
And they highlighted some unique strengths they feel they have in this environment, right?
Yeah, several points. First, obviously, those booking curves. Being almost sold out for 25 and well into 26 gives amazing visibility. Plus, cancellations are normal, so the bookings are sticky.
What else?
Their direct marketing engine. They really lean on this to drive demand without just slashing prices. Targeted marketing, better digital tools, empowering their sales team.
And this works well with their specific customer.
That's the idea. They describe their target demographic as, financially stable, more time, prioritizing experiences, historically resilient in downturns. They think this group is less affected by general economic jitters.
Makes sense. Anything else?
The strong balance sheet, that 2x net leverage, lack of near-term debt maturities gives them stability and flexibility. And they pointed to the management team's long tenure, 20 years, experience navigating tricky economic times.
Okay, any news on ship orders beyond 2026? They seem to be planning way ahead.
They are. Since the last update, they exercised options for 2 more ocean ships, but these are for delivery way out in 2031.
2031?
And they signed an option agreement for 2 additional ocean ships for 2033 delivery. Same 998 guest size, built by Fincantieri. So the committed ocean order book now stands at 11 more ships through 2031.
Wow. And anything on the riverside further out?
Yes. They announced a new river vessel for Portugal on the Douro. That'll be their 6th ship there, coming in 2027. Shows long-term confidence.
Any other highlights from Q1, specific achievements?
Well, they talked more about the Viking Libra, one of the 2026 ocean ships. It's going to be basically the world's first cruise ship designed to run on hydrogen.
Hydrogen, really?
Yeah, a hybrid system using liquefied hydrogen and other fuels, aiming for zero emission capability. They seemed really proud of pushing the environmental tech angle, said it shows true zero emission is possible.
Interesting. Does it affect the ship design?
Slightly. It'll be a bit longer to accommodate the tech, resulting in a few more cabins than their current ocean ships.
They also took delivery of a new river ship.
Yep, the Viking Nereus, built specifically for the Seine River in France, Paris and Normandy cruises.
And they mentioned expanding beyond Europe too, right? Places like the Mississippi, Egypt.
Exactly. Mississippi, they feel they're getting it right. Egypt, they're up to 6 ships, maybe heading towards 10. Their expedition cruises, Antarctica, Greenland, seem well received. And even smaller things like India on the Brahma River. Smaller scale, but attractive growth areas.
Okay, let's pivot to the Q&A with analysts. Always some interesting nuggets there. Pricing seemed like a hot topic.
Definitely. Analysts asked if they were using promotions or discounting, given the macro picture. Management's answer was pretty firm, no.
No promotions for future seasons.
That's what they said. They explained pricing is complex, depends on the season, the cabin, the itinerary, but they feel the consumer is resilient, willing to book ahead.
So what's their outlook on pricing?
They said if the economy holds steady and recent demand keeps up, they're confident pricing can grow in the mid-single digits on top of the capacity growth. Marketing is their first tool, not price cuts.
What about the booking window? Is it shrinking?
They said no material changes. The percentage booked now versus prior years is similar. That long window seems to be holding.
There was that difference in Q1 yields, river down slightly, ocean up a lot. Did analysts probe that?
They did. Management just reiterated the river seasonality point Q1 isn't representative. And the ocean Q1 boost from the world cruise mix. They pointed again to the full year booking curves, 95% river, 91% ocean for 25 as the real indicator.
How about margins? Are they structurally higher now than pre-pandemic?
Management thinks so. They expect margin growth from capacity increases and those mid-single digit rate hikes. A lot of leverage comes from controlling expenses, especially SG&A, as they scale.
So committed to margin growth, but not at the expense of quality.
Exactly. Prudent on costs, but they'll invest to keep the product strong.
If demand did soften, what's the first sign they'd see, and what would they do?
The key signal is booking pace. They watch that constantly. And the first lever they pull, direct marketing to stimulate demand, not price cuts. They feel their database and long booking window give them advantages there.
Would they expect softness in river or ocean first?
Interestingly, they said probably both. They run Viking as one brand. They're agnostic where the booking comes from. But crucially, they stress they are not seeing any softness now. Momentum is very good.
Okay, someone asked about the 2026 rates being booked, now already being higher than 2025's were at this point last year. Isn't that unusual? Don't rates typically soften as you get closer?
Management pushed back on that idea, said dynamic pricing is nuanced. It responds to demand. It's not a rule that rates have to tick down. They even gave an example from 2024 ocean where rates increased over time.
So they think they can maintain that mid-single digit yield growth for 2026?
They sounded confident, yes. Assuming stable macro, continued demand, and their marketing approach, dynamic pricing adjusts.
And they confirmed the recent booking strength in April-May is that acceleration.
Yes, they explicitly said they saw strong momentum in April and May for future seasons. Pleased with consumer resilience, the 37% booked for 2026, and how sticky those bookings are. Great visibility.
Did they address concerns about Americans maybe hesitating to travel to Europe? I think another cruise line mentioned that.
They did. Viking's response was clear. We are not seeing that issue. Europe is huge for them, like 70% of itineraries, and they said demand is strong.
What about analysts seeing different pricing trends externally?
Management basically said, can't verify third-party data. Our internal data shows pricing is holding firm, up year over year for 2025, and recent trends support that.
Do they expect a big booking surge in the fall for 2026? or is it more steady?
They sell year-round because of direct marketing. Wave is key, yes, but they keep marketing. They might even open seasons earlier if demand warrants it.
Any change in using other promotions like cabin upgrades or add-on incentives?
Nope. Still focused on marketing the core value, not those kinds of tactics.
And just to be crystal clear, no softness seen in April or May.
Correct. Only accelerating trends as May progressed.
Okay, the laid-up ships in Russia and Ukraine. That came up right.
Yes, the 5 in Russia, 1 in Ukraine. Management said they are being kept shipshape, ready to go.
Ready to go if the situation changes. And did they quantify the potential impact?
They didn't give a hard number, but said the potential EBITDA contribution from those 6 ships is significant if they can return to service. Management expressed hope for a resolution soon. It's definitely an interesting potential upside hanging out there.
Did they clarify if they are tweaking how they manage bookings, like holding back rooms?
They specifically said they are not holding back inventory. Their system dynamically prices based on everything: economy, sentiment, booking pace. Prices can go up, like they did for River 2025 recently. They'll keep using dynamic pricing for 2026.
Last thing, cost management. How do they do in Q1, and can they keep costs down?
They were proud of Q1 cost control, pointed to efficient ship designs, River carrying more guests than competitors on a similar footprint, Ocean avoiding things like casinos, good crew ratios too, helps fight inflation.
So the focus is on internal discipline and getting leverage from scale, especially in SG&A.
That's the message, balancing cost control with investing in the product. They didn't promise negative cost growth, but highlighted their advantages.
Okay, time for our disclaimer segment. What we discuss next is derived only from the information in the earnings call we just covered. It is purely for illustrative purposes.
Let us be extremely clear. This is not financial advice. Trading involves significant risk. You could lose your investment.
Right. So based only on what was said in the call, Viking has those 6 river ships, 5 Russia, 1 Ukraine kept ready to sail. Management stated they can provide a significant boost to EBITDA if the geopolitical situation allows them back in service.
Okay, so the outrageous but plausible trade idea, completely hypothetical, using only that piece of information.
You could, theoretically, look at something like long-dated, out-of-the-money call options on Viking stock.
The idea being you target a strike price way above the current level, implying a big jump in value.
Contingent solely on those 6 ships coming back online and contributing significantly to earnings, just as management suggested they could.
It's a total gamble on a specific geopolitical event mentioned in the call having a major impact that the market isn't currently pricing in. Very high risk, potential high reward maybe, but pure speculation.
Absolutely. Again, not advice, just an illustration connecting a specific call comment to a speculative idea. Don't trade based on this.
Please don't. Okay, let's wrap up.
So recapping this deep dive on Viking's Q1. Strong results, positive EBITDA in Q1, which is unusual, fueled by more capacity, full ships, and better pricing.
Incredible booking momentum. 2025 is basically done. 2026 is already significantly booked at higher rates, shows their customer is resilient and the direct marketing works.
Solid balance sheet supporting more ship growth, including that cool hydrogen ship tech.
And that potential picker from the 6 laid-up ships if, the world situation changes.
Remember, everything we discussed was based strictly on that earnings call information. It is not financial advice.
So as you digest all this, what stands out to you? Does seeing Viking booked so far in advance change how you view stability in travel?
And how big an impact could those 6 ships really have if they returned? Something to think about.
Thanks for joining us for this deep dive.